This is the third and final webinar in this series, and I suggest if you haven't had an opportunity to see the first two that you do go back and watch those. What we don't know can ultimately cost us a lot of money. And for many people, getting ready for tax season can be very scary. It can be stressful, but it doesn't have to be. Our firm prepares taxes for childcare owners and other small business owners in all 50 states. And what we found from coast to coast, from the northern states to the southernmost states, is that most people have such an unpleasant experience with tax preparation simply because they don't understand how it all works. So it's my hope and goal that by the end of this final presentation, you have a much better understanding of the process and how to be ready so you don't have to get ready for tax season this year. So I am ecstatic that you're here today because we're going to go deeper into talking about our tax filing status options. And I'm also going to teach you how to advocate for yourselves effectively. These skills will help you to save money, reduce stress, and ensure you're getting the most out of the tax system for yourself. Now that you know what to expect, let me take a moment and introduce myself. My name is Shanita Jones. I've been working in the tax and accounting industry for over 20 years, but more importantly, I specialize in helping childcare providers like you. I've worked with thousands of daycare owners, family childcare providers, even centers and franchise owners. So I've seen firsthand the unique challenges you face, not in just running your business, but also in navigating the complicated tax systems. And these systems were not designed with you in mind. But that's why I'm here today, to empower you with knowledge, tools, and strategies so you can feel confident and in control when it comes to taxes and your money. So, I'm going to share a quick story about why I became the childcare CPA. It all started with my aunt. She's always been passionate, caring for children. She was my first teacher. She taught me how to read. And even more important than that, she taught me how to learn. She started her home childcare and she quickly realized how complicated things really were when it came to taxes. From calculating time space percentages to figuring out what was deductible and what wasn't, and even choosing the right tax professional became a struggle. And it was quite overwhelming for her. She was afraid of making mistakes, worried about audits, and didn't feel like her tax preparer really understood her or her business. In fact, the person that was doing her taxes ended up getting her into a lot of trouble. At the time, I was working full time as an accountant for University of Pennsylvania, and I had a small tax business on the side. I didn't do business taxes, and I definitely didn't do childcare business taxes. But my aunt was at the risk of losing her business. She was hit with levies and liens from the IRS. I had a lot of colleagues that were further along than me. They did business taxes. So naturally, I tried to send my aunt to those people who I thought were the best, but none of them were willing to take on her case. As accomplished and skilled as they were not familiar with the childcare industry. My aunt was already in trouble, so no one wanted to take the risk of possibly making matters worse for her. They couldn't understand how she legally claimed to write off 60% of her home. They couldn't understand how she could have a business that was open almost 24 hours a day. They couldn't understand how she worked with a professional and found herself in so much trouble with so many authorities. My colleagues assumed that my aunt was complicit in some sort of wrongdoing, and now she wanted to get help because she was in trouble. So, although my aunt is educated, she's an educator. She wasn't educated in the area of accounting and tax, and her child care studies didn't teach her this. Her training focused on child development, curriculum, safety. So she had the business part down pat, but the paperwork and the numbers and the business side, she had a lot of room for improvement there. I'm sure someone listening could relate to this. My aunt didn't know how to advocate for herself. And when she sought professional help to advocate for her, she was met with judgment, skepticism, and people that weren't knowledgeable enough in her industry to really help her. So after we heard so many no's and people that did not want to get involved, I had no choice but to learn everything I could to understand how to help her. I refamiliarized myself with things that I'm going to talk to you about tonight, like the IRS's Taxpayer Bill of Rights. Yes, you have a Bill of Rights with the IRS. I looked into the Taxpayer Advocate Service. Yes, there's a free service that will help you if you're in trouble. So, despite me not particularly wanting to get involved, I discovered I had no choice. After all, I knew the impact that my aunt had made on my life and the lives of the other children that she touched over the years. So, I stepped in to help and we untangled the mess. We saved her money in her business and we built systems to help her make her taxes more manageable. Helping my aunt opened my eyes to see how many childcare providers were in the same boat. After her tax situation was resolved, she told a friend, and that friend told a friend, and they all were going to the same person. I was able to help most of them too. Next thing you know, I became known as the daycare tax lady around my city at the time, which was Philly. My goal today is the same as my goal was back then, to simplify these complicated systems so that you can focus on running a successful business without worrying about tax season. So, here's my disclaimer. Please note that the opinions expressed in this presentation are those of my own. Nothing that you see or hear in this recording, materials, or live presentation should be construed as tax advice specific to your situation. For tax advice specific to your situation, you should contact a tax professional. At no time will we ever offer legal advice or services. For legal advice, you should contact an attorney at law who is licensed in your state or the affected states. So, I do want to do a very quick recap of everything we talked about. For those that were here, I want to make sure you realize how far you have come. And for those that may have missed something, I want to show you what you might need to go back to look into. So, in session one, we talked about why it's so important to prepare early. And I shared with you the key deadlines that the IRS has and rules surrounding those deadlines. We went over all of the documents you may need and why. We gave you some tips on how you can get organized without feeling overwhelmed. And we even gave you a really cool checklist to help you keep everything nice and orderly. We covered some basic tax terminology so that you're feeling comfortable with some of the jargon you might hear. We talked about some systems that might work for you and some mistakes that you can avoid, some common mistakes that we see. Our last session together, we got deep into some deductions. I literally believe that you know everything now that you could possibly write off on your tax return if you were here at the last session. We went over some key terms. We got familiar with the forms. We mastered the time space percentages. We talked about some ways we could save in taxes and enhance our record keeping. We also looked at common mistakes where expenses and write offs are concerned. And the resource there was the time space ratio. And because California, you all have been so amazing, someone asked CCPU for a list of deductions. And tonight I gave them one. So you will be getting that soon. So now I talked about what we talked about already. Let's talk about what we're going to talk
Ya
about.
repasamos de lo que hablamos anteriormente. Oops, sorry.
That's okay. Am I speaking okay? Is my speed okay? Okay. I think I'm good. So, um, before we dive into the content, I want you to think about it. What is your filing status? Are you single, married filing jointly, married filing separately? Are you head of household? Don't worry, this is just for fun and to see where everyone is starting from. Also, if you have any specific questions, please feel free to drop them in the chat and we'll do our best to answer as many of them as we can. I'll give everyone a minute to go ahead and get that organized. And I'm also going to keep a watch, if I can find it again. I'm also going to keep watch of our questions that we have to make sure if we're covering a part that includes the questions that we can work that into the presentation. So I may take a minute to pull that back up. Okay. So in the first webinar, we talked about preparing for taxes, and we did talk a little bit about filing statuses and why it's so important to select the right one. I told you how to determine that status. Tonight, I'm going to give you a flow chart where you can actually follow it with your fingers to make sure you're getting the right filing status. Now, this is going to be particularly useful to those of you that prepare your own taxes. For those that work with a tax professional, the tax professional is really responsible for making sure the right filing status is selected initially. And then I'm going to teach you how to advocate for yourself to make sure what's happening is what's supposed to happen. So if you work with people that work with us will notice on our organizer, we don't actually ask our clients what their filing status is. And that's because it's the tax professional's job to determine what the filing status is based off of the information, the questions, the responses you give. So you will notice that when you work with a professional, they often will just ask you questions about your family situation. They'll ask you a lot of questions about your family situation. So if you have questions or concerns, do please feel free to drop them in the chat. So this is our deep dive on filing status basics. Your filing status is the cornerstone of your tax return. Your filing status is going to dictate what your tax rates are, what you're eligible for in terms of credits. If you owe money, it's driven by your filing status. If you're getting a refund, it all starts out being driven by your filing status. So it's very important that this is correct. Your filing status is only going to be one of five things. And those five things are single, married filing jointly, married filing separately, head of household, and a qualifying widower. So the impact that your life changes have are going to influence your filing status. So you've been working with the same tax person every year, even if they're a friend of your family and they may know you personally, make sure you remind them if something happened in your family, such as a marriage or divorce, a new adoption, or a new child being born, or maybe you're taking care of a grandchild or a niece or a nephew. Just because they know, it doesn't mean that they know when they're doing your return. And these are the five filing statuses that I just listed that the IRS recognizes. So each filing status is going to have specific criteria and implications for your tax obligations. And we're going to talk about each one in more detail. When determining your filing status, the first question you need to ask yourself is, was I married? And that may sound like a simple question to some of you. Some of you may say, well, of course I know if I'm married or not. But you have to think about, were you married as of the last day of the year that you're filing? So right now, most of us are working on filing our 2024 taxes. So when you're going to do this tax return and you're asked about your marital status, they're asking if you were married, pulling this up because I want to show this to you. They're asking if you were married as of December 31st, 2024. So this is the resource you're going to get today. And you'll see the first thing you ask is, am I married? And then if you are married and you follow the flow chart, you'll get to the right filing status. So I'm gonna move this out of the way for a second. So even if you got married on January the 1st, 2025, you were not married in 2024. So if you're behind on your tax filings, and your family situation changed, it's important that you think back to what your marital status was for that year that you're filing as of December the 31st. Now, single applies if you are unmarried, divorced, or what the IRS calls considered unmarried. And you are considered unmarried if you and a person you are legally married to are separated the last 6 months of the year and you have a dependent child that you're caring for. And I'm going to have plenty of examples to help make this clear for you because I know it can be a little complicated. So, if you are married, you have a choice. You can file a joint return where all of your income and your deductions are combined. This often results in a lower tax liability. So, for example, if you and your spouse were married on December the 31st, if you actually walk down the aisle on New Year's Eve, you can file jointly for the entire year. Even if only one spouse has income, you would file a joint return. Even if your spouse does not work or have income, you cannot claim your spouse as a dependent. So we get that question a lot, and there's usually a lot of confusion about that, but you cannot claim your spouse as a dependent. Some married couples decide to file separately because they want to keep individual responsibility for their tax liabilities. Now, filing separately is usually not best, but there are some situations where it is more beneficial. Some of these situations are where one spouse owes a lot of money on taxes or child support, excuse me, or if one spouse has really large medical expenses or miscellaneous deductions. But it's important for you to know that if one spouse itemizes, both spouses need to itemize. We also see people that have student loans and they want to get an income based student loan repayment plan. In that case, sometimes it makes more sense to file separately. So before you make that decision, you'll want to actually do the math and think about how much will we have to pay monthly if we file together, how much would we owe if we're going to owe. So, and sometimes if you're working with a tax professional, sometimes that is an additional charge depending on how deep you want this person to go in splitting things. Some couples might choose to file separately because their spouse owes student loans or child support or unemployment or some other form of government debt. Okay? So it's important that you're aware that filing separately might benefit you in one of those situations, but it could also disqualify you from getting certain credits and deductions. Also, if you're married and you decide to file separately, you cannot take the student loan interest deduction or the tuition and fees deduction for years where it's applicable. If you are married filing separately, you cannot take the credits that are shown on my screen. That is the Earned Income Tax Credit, the American Opportunity Tax Credit, the Lifetime Learning Credit, the Child and Dependent Care Credit, and in some cases, most cases, the Adoption Expenses Credit. You also should know that your deduction for IRA contributions is reduced or sometimes eliminated, depending on your situation, if you decide to file separate. And then the threshold for phasing out on certain deductions, meaning once you make so much money, some things are just off the table, that becomes lower when you're married filing separate. So I want to be super clear that married filing separately can result in a lower tax liability in many cases. Married couples will end up paying more combined if you add spouse one and spouse two when you file separately, as compared, excuse me, to if they file jointly. So that's important to know. And you'll want to talk with your tax professional if you have concerns, and they will help you be able to sort out the pros and cons of each. So, married couples can also file a joint tax return. And on this joint tax return, income and expenses are combined. And this usually results in a lower tax liability. So if you and your spouse went to Vegas and you got married on New Year's Eve, you can file jointly the entire year, even if you were only married one day, even if only one spouse has the income. It would be a joint tax return. Now, people will come to us and say, I need the head of household filing status. No, they'll say single head of household. That is not the name of a filing status. I don't know who started it, but it's not. The head of household filing status is for people who are unmarried and they've paid more than half the cost of maintaining a home for themselves and a qualifying person, such as a child or a dependent parent. This status offers a higher standard deduction and more favorable tax brackets than if they were single. Now, sometimes we will have a person that's single and still file them single with a child that they support and not give them head of household if the refund is going to be the same. Because the IRS does place a lot of scrutiny on the head of household filing status. So you'll never be penalized for not taking something that you're entitled to in terms of a filing status. But with the head of household filing status, the IRS I do want you to know they are doing a lot of letter sending and asking people to prove that you maintained over half of the house expenses and your relationship to your dependents. So I'm not saying it to discourage you. Sometimes it's a difference of thousands of dollars. I just want you to be mindful, like we talked about in webinar one, that you have all of your documentation. So you have to be single or considered unmarried, considered. And you're considered unmarried, you're filing a separate return from your spouse. You paid more than half of the cost of keeping up your home for the tax year. Your spouse did not live with you the last 6 months of the year. And your home was the main home of your qualifying child for more than half of the year. And you can claim this child as a dependent. So, some additional requirements. You must have that child. Now, there are some special cases. If your spouse is a non resident alien, you may be considered unmarried for head of household purposes, provided you do not choose to treat your non resident spouse as a resident alien. And then temporary absences. If your child is away at camp or if someone is in prison, temporary absences do not necessarily disqualify you. Military deployment, medical treatment, or even if someone's away at a different type of school. Okay. So it's important to know that those circumstances will not disqualify you from being considered unmarried. Um, Now, as a cautionary note, filing head of household when you're married is a complicated situation, and you want to be sure you evaluate your situation and that you do qualify. Because if your spouse is filing separately, and you're filing head of household, those IRS systems we talked about, they're running checks. So if they decide to check, you want to make sure that you can prove what you documented. I represent a lot of people against the IRS in audits surrounding this. That's why I'm trying to really make sure I'm making it clear. Let's talk about the qualifying widower filing status. A lot of people have never heard of this filing status. And this is a filing status that can be used if your spouse passed away within the last 2 years and you have a dependent child. Then you might qualify for the status. This status allows you to use the same tax rates as married filing jointly, and it helps to give some financial relief during a challenging time. So, for example, if your spouse died in 2023 and you have a dependent child, you could file as a qualifying widower for 2024. In 2023, even if your spouse died that year, you could still file as married filing jointly. So, selecting the appropriate filing status, it depends on various factors, including whether you're married or not, if you have dependents, and your financial circumstances. The IRS does have another tool, and I'm going to show it to you. It's pretty cool. And you can actually go on their website. They have several tools here, by the way. And I'm saying tools, TOOLS. And you can actually click this link and go through this, and it'll ask you a series of questions that you can answer for yourself to make sure you're using the right filing status. So as you go through, it'll ask you what year you're talking about, and you get to tell it what your situation was. And once you pick what it is and you answer some questions, it will help you arrive at your filing status. So just in case you weren't sure, and this tool is called the Interactive Tax Assistant. It's free. It's on the IRS website, and it's open to everyone. Anyone can use it that would like to use it. So there are some common mistakes we want to avoid, such as incorrectly claiming head of house, meeting all the requirements, and overlooking that qualifying widower status. You also want to be careful about taking advice from people that will tell you you're automatically going to owe more in taxes if you file together with your spouse. But you need to think about how you and your spouse treat finances. If you and your spouse keep everything separated, then and your portion is going to be a refund, it might make sense for you to file separately. But generally speaking, if you and your spouse keep everything together or you want to do what's better for the household, in that case, most of the time it's better that you file jointly. So there's only 5 filing statuses: single, married filing jointly, married filing separately, head of household, and qualifying widower. The filing status impacts your taxes and your tax brackets. So, for example, in 2024, a single person would be in a 22% tax bracket if they make between 47,000 and 100,000. Married people would be in that same tax bracket if they made between 94,000 and 201,000. And then head of household is somewhere in the middle. They're between 63,000 and 100,000. So there is no more marriage penalty in there. And our standard deductions, which we talked about, I think we talked about that in webinar 1 and webinar 2. Your standard deduction, and again, a deduction reduces how much of your income is going to be taxed. For single, it's 14,600, and married filing separately. For married filing jointly, it's 29,200. And for head of household, it's 21,900. So your filing status, it affects those tax brackets, it affects those standard deductions, and remember, it also determines which credits that you're eligible to take advantage of. So that's why filing status is so important. And we ask so many questions. Now I want to go through and explore some real life scenarios with you all that many taxpayers face, because it's more than just checking a box on your return. It's making sure that you understand. And if somebody tries to do something that you don't agree with, I want you to be empowered enough to ask questions. Our first example is a single parent They have shared custody with the other parent. And imagine that this provider, we'll use a guy. He's a single parent, he's a child care provider, and he lives with his child most of the year and he shares custody with the mother. Which filing status do you think he would qualify for? So you may say he qualifies for head of household because the child lives with him for more than half of the year and he pays more than half of the support for maintaining the home. If he selected this, he would get a higher standard deduction. He would be eligible for all of the credits that we mentioned if he qualifies. And he would have more favorable tax situations than if he was just single. Now, he might have to qualify as single if he didn't meet the requirements of actually having the child more nights than the other parent. So the IRS has a test where they actually break down to see who had that child more nights, and they count nights, not days. So let's say you pay the rent, utilities, and groceries for the child, for your household. The child lives with you for 8 months during the year. In this case, this child care provider, this taxpayer, could qualify as head of household. But if that kid only lived with you for 4 months, now you would have to file as single. So usually I ask people what they think about that. But I'm going to trust that if you have questions, you're gonna note them down and we'll get them in our question sheet. So let's talk about another example. Our second example is going to involve a child care provider who is married but separate. And this situation can make choosing the filing status a little bit more tricky because we have two people, they are legally married, but they don't live together. They can choose to file jointly even though they don't live together. And this option typically results if they file jointly, they'll have lower tax rates and be eligible for more credits. But both spouses would be jointly responsible for any tax liability. So if your spouse has income that you want to combine, or if they qualify for deductions, this might be the way you want to go. But because that couple in our example did not live together during the year, they could also file separately. Now, the spouse, and I saw that somebody said, what if it's 50-50? There's 365 days in a year. So it's impossible to be 50-50 nights because five is not a round number. So on a leap year, maybe, but not on a regular year. So to be married filing separately, it might be beneficial if one spouse made a bunch of money all year and didn't pay any taxes, or if you're entitled to a refund filing together and maybe that other spouse, you know that their taxes will be garnished. It might make sense in that case. So imagine you're legally married, you didn't live with your spouse all year, and if your spouse has, for example, a history of not paying taxes, it might be a situation where you might need to evaluate that and see what's best for you. And this one, we don't see this filing status used a lot. I guess that's a good thing because we only use this one when someone passes away with young children. And this can be overwhelming. And the government understands that. So they did build some grace into the tax code. And we can use this status if a spouse died within the last 2 years and they left the other parent supporting a dependent child. Then you can qualify to file as a qualifying widower with dependent child. And this status allows you to use the same tax rates as married filing jointly. So this is even better than doing head of household. So if you aren't aware that this exists, you may incorrectly think, well, I'm not married anymore. My spouse died last year and I have this child. So I'm head of household. Yeah, you do qualify as head of household, but it would be more beneficial to you to file as a qualifying widower. So, um, we just did a few examples. So I think everybody got it. And I want to make sure I leave you all a lot of time to ask questions tonight. So, our key takeaways for filing statuses, because we're going to break in a minute, is that your filing status affects your tax rate and your deductions. Life circumstances like custody, adoption, or separation, deaths play a critical role. You want to evaluate all of your options carefully. So remember, your tax filing status significantly impacts your obligations. Okay. So by understanding these different scenarios, it will help you to make informed decisions. And if you're ever not sure, you can use the IRS's interactive tax assistant. And remember, it's not just for filing status, they have all kinds of stuff on there. And it's not in crazy tax jargon, it's in relatively easy to understand English. Um, and this site, I do believe, is translated into other languages as well. But you can also work with a tax professional to guide you. And I'm going to talk to you today about making sure that you are choosing the right type of tax professional to guide you. So I don't know if the union is ready yet, but now is a really clean break for us to pause before we come back and talk about advocacy.
Thank you, Shanita. Thank you for sharing
Thank
all the
you.
great resources and information. So right now we're gonna take a 20-minute break. The union will be coming on the screen to provide some really helpful information. It is optional. You have the choice to stay. Otherwise, this is a 20-minute break. Right now it's 6:58, so let's jump right back on at 7:18. So we'll go ahead and let Anna, you can share your screen, and Deborah, you can start whenever you're ready.
Good evening, everyone. Miss Deborah, are you here with us?
Oh, yes, I'm here. You can hear me? You can see me?
Yes.
I'm echoing.
All right, let me get my screen going. Good evening, everyone. My name is Anna Farfan. I'm an organizer with SEIU, Local 521 CCPU. And Miss Deborah, you can introduce yourself.
Okay, well, I'm echoing. Am I echoing on your end also, Anna, and everyone?
Yes.
Okay, so I don't know what's causing the echoing.
Not sure. Let me get this. There you go. All right, Miss Deborah.
Am I still echoing?
No, not anymore.
Thank you for that. Well, I want to say I'm echoing. I know you want to hear me twice. Hey, y'all go.
Yeah.
Let's see what the big deal is. I don't know what's causing it, to be honest.
You let me know when you're ready.
Oh, I know.
Can you see the screen?
I've got.
Miss Deborah, do you have a headset? That may help with the
I've got
echo.
two Zooms going, that's why.
Yes.
Can you kill one of those for me, please?
Deborah, you need to mute one of your devices so there's no echo. So just
Okay. Still echoing.
maybe switch it up again.
If someone can do.
So you need to mute your actual device, not the Zoom as well, but your actual device, you need to mute it as well.
Can you hear me now?
Yes,
I'm
and
not.
there's
You
no
guys can hear
echo.
me good now?
Yes, perfect. You're good to go, Miss Deborah. You let me
I
know when
can't
you
hear
want
you,
me to.
Anna.
Can you hear me? Can you hear me now? Miss Deborah? No? Maybe
Can't hear you,
it's.
Anna.
I can hear you.
Deborah, can you hear me?
So maybe you need to unmute your other one. Miss Deborah, can you hear me?
Can you hear me, Anna?
Yes.
So everyone can hear me.
Yes.
I just can't hear you.
Yep.
So go ahead and let's go ahead and get this started.
Okay.
So once again, here we are, Family Child Care Providers United. Go to the next slide. Let the slides roll. Here we are. And I know we all have heard, this Phil skit conversation before, but there's a reason why we're here. This group here in this picture represents providers throughout the state of California, standing united, side by side, raising their fists. Si se puede, yes, we can. The reason why we stand united is because we know what we deserve. We know what we work for. But standing united is what has made a difference and why we are even here in this training. Next slide. Who is CCPU? We're CCPU, California providers. We make up CCPU. We make decisions in CCPU as we come together and stand. As we all know, 40,000 providers came together, voted, and said yes. And with that yes, we made history and we make changes. Next slide, please. Again, through all of our work, united with Local 521, 99, UDW, these are the changes that we made for California providers. But the changes we made, only way they continue is as we grow our union and we continue to use our voices, stand up, and make a difference. You can't make a difference at home. You can't make a difference in the corner. You can't make a difference in the closet. You have to come out. You have to join. You think things are going to be changing now with this new administration? Well, then you're going to have to stand up to it. You're going to be the one that makes the choice and the decision. Don't be that provider who stands at the house and makes phone calls. What's going on? What's going on? Be that provider in the middle of it, a part of the changes, making the changes so that we can be a difference and continue what we're doing. Go ahead, Anna. Our vision is clear. Our vision, wipe it out, ladies and gentlemen. Our vision is clear. We want what we deserve. We want our true cost of care. We want the rate reform. We want our contract signed. We want what we deserve, but we can't get it, you all, by sitting back. Our vision is clear. We want what we deserve and what we continue to fight for. Early care, we want our children, our providers, to have a fair cost of the true cost of care. We want our providers to receive what's true and what is deserving of them all. Again, our vision is clear, but not the state's vision. Our vision is clear. So in order for the state to get a hold to our vision, understand what we're demanding, it's going to take everyone here. Everyone here plus. Next. The union, again, is made up. We've of so many providers throughout the state of California, but we need to continue to grow. We need to continue to come together and everywhere and to continue to make a difference. With our union, yes, we have a seat at the table. All right, thank you for the seat at the table. I appreciate it. All right, you're going to put the plate in front of me. Okay, here we go, here we go. Oh, you putting some food on my plate. Thank you for the food. Well, wait a minute. This ain't enough food. This can't feed me. This can't feed the providers. Don't just invite me to the table for lunch, dinner. You can't just do that. If I'm going to sit at this table, I don't just want to be invited to sit to be a showman. No, I want you to listen to what I'm saying, state. I want you to implement what I'm saying, state. I want you not to just to listen, I want you to move it. I want you to understand. But the state can't get it if we're not there making a difference. The state will never get it if providers do not continue the fight we're on. It's going to be a harder fight, but you got to be willing to join and participate. Next, please. Okay, here's the fish again. We've all seen this fish before because it doesn't change. Oh, it's repetition. We've seen this before. Here's the state with another pitch because it doesn't change. We have to grow our union. We have to participate. No one's going to give you anything sitting back. The providers we have at the table that are fighting to make a difference, that is with the support of every provider in the state of California. But if you know and realize the state doesn't move, it doesn't change. There's no movement until we do an action. Why do we have to do an action for you to move? We want the state to move without an action. We want them to listen, but don't get me wrong. If it takes an action, you got darn right. Let's go. Sign us up. Let's move on. Let's do this. But this is what what we have to do. This, seen it before, same old fish. You're right, same old state. Same old state, playing the same old games. But that's what it takes. Don't ever forget this picture because it's real. It's never going to go away because this is what we're always going to be dealing with. But the difference is us growing and growing and growing and growing. Next, please. You already know the first contract. You already know what we received in the first contract. We already had our second contract. Now we're going into our third contract. If you didn't participate in the first contract or the second contract, I'm going to tell you right now, you better be here for the third contract because this ain't no joke. Everything we accomplished, that first contract, I was during the pandemic. The pandemic. And then we went on to our second contract and continued to do things and accomplish. But we got a new administration in Washington, D.C. So the fight's going to be even harder. But again, I'll say it. It's going to take everyone here plus this training here, thank you, CCPU, and continue to grow us. That's what it's taken for us to get here today, is all the providers. Next one. Our future depends on all of us, everyone here. I can't say it anymore. All right, enough, I should say. Can't say it enough. This young lady here, this provider in this picture, next time it should be you. If you can't make an action, if you're not able to close and go to Sacramento or whatever the case, just in an actual action, then when the union calls and asks you to participate in another action, if it's emailing, if it's calling, sending fax, those are actions you can participate in. Then you have to encourage others to do it because those actions work. We need everyone. Everyone, if we want our benefits, if we want our trainings, if we want our true cost of care, it's going to be you, our future. See, let's deal with let me just lay it out. I don't have a script. Anna's just rolling the slides. Next one you can roll over too, Anna. But this is me talking to all you providers, especially those brothers and sisters out there who know me. They know this is me. I want everyone here to understand and know. You're right. We cannot become stronger without you all. This picture is real. I'm in this picture. This is when we went to LA and Governor Newsom was there. And all these providers were there. And he shook everyone's hand on a stage. We thanked him for giving us the right. When he signed AB 378, I don't remember a lot of things, but I remember AB 378, gave us the right to organize. History. These providers here met down there with the governor. I'm in here with all my brothers and sisters. This is a thankful historical moment for all of us. And we have to continue this. I really want you guys to click the QR code, I think that's what they're called, to join the union. If you're here in this meeting and you're not a union member, I'm asking you personally to join us. And then I'm asking you to ask someone else to join us. It's not what can the union do for me, it's what we can do for ourselves. We're the union. What can we do for ourselves? How much stronger can we make ourselves? How do we make sure that we continue with what we've received? How do we make sure we don't lose anything? We, right here in this picture, we come together. Si se puede. Yes, we can. Yes, we can. Stronger together. I'm looking at these faces. I'm totally overwhelmed. Dear friend of mine is somewhere in this picture. Shirley Amos. She passed away 2 weeks ago. I'm still struggling with this right now. You know, a provider said to me, I'm going to retire, Deborah, because of what happened to Shirley passing away suddenly, because she wants to live, because we dedicate our lives to what we do. Shirley will call me in a minute. Debbie, what we doing? What's going on? She believed in me as I believed in this union. And she believed in the union. But she's one of my dear friends, and she knew she could always call me. But that meant the world to me that my friend believed in me the way she did. And that gives me even more strength to continue to do what I do, to stand strong for all the providers. And I'm asking you all, especially those who are not members of the union, join us, because that's the only way we're going to make a difference. And the union members, ask someone else to join. What can the union do for me? What can we do for each other? We can grow and make a difference. I'm good. Thank you.
Thank you so much, Deborah and Anna.
So, okay, we are back. And in the second part, we're going to talk about advocacy and some advanced strategies. So, do you remember the story I shared with you about my sweet aunt? She was in trouble because she thought she was doing all the right things, but she trusted the wrong people. And she found herself in trouble and didn't know how to fight for herself. She didn't even know she had the right to fight for herself. She thought once the IRS or the state or the city said you owe money that she absolutely had to pay. Well, my aunt and her friends, like millions of Americans and countless childcare providers, thought that once the IRS or their state sent a tax notice in the mail, that is absolutely correct and that is final, and that they must comply with whatever is said, and pay whatever is requested of them. Now, while this is true in some cases, if you owe, you will have to pay up. But the IRS, the state of California, or the city that you live in is run by humans, and humans make mistakes. So you don't want to blindly pay up if you aren't really obligated to pay. And this is where advocacy comes into play. My aunt and her friends didn't have anyone to advocate for them at first. They weren't aware they had rights. So now I want to spend some time sharing with you what your rights are and where the tax code is concerned. And we find these rights in the IRS's Taxpayer Bill of Rights. Did you even know that a Taxpayer Bill of Rights existed? Many people still don't know, but you're here, so you know now. These are the Taxpayers Bill of Rights, and we're going to talk about what they mean. These are 10 rights every taxpayer has. You have the right to be informed. You have the right to quality service from the IRS. You have the right to pay no more than the correct amount of tax. You have the right to challenge the IRS and to be heard. You have the right to appeal a decision. You have the right to finality. You have a right to privacy, confidentiality, and to retain representation. And you have a right to a fair and just tax system. So, we're going to talk about what these rights actually mean. The right to be informed means the IRS must be clear and provide understandable explanations about your obligations. They have to make it easy for you to understand how to comply with the laws and to understand what actions they're taking on your account. They also have to explain notices or letters that are sent to you outlining what you owe or the actions that need to happen on your part. Now, I do want to say the IRS, just because you have this right, it doesn't mean that the person you speak with is now your new BFF. It doesn't mean that, but it does mean that they're not supposed to mislead you. So an example of this is if you receive a notice from the IRS about a discrepancy in your income, this right to be informed ensures that they have to tell you why they're saying they believe there's a discrepancy. The right to a quality of service. This means you're entitled to a courteous and professional person at the IRS. You should be able to receive timely and clear answers to your questions. And if the IRS is not courteous or they do not give you timely information, you can file a complaint. You can call the IRS, and if you feel you're being rushed or dismissed, ask for a supervisor. When you call the IRS, they all give you their employee number. Write it down, write their name down before anything goes wrong. So this way, if you need to call back or you need to say that you spoke with someone and they gave you something, these calls are logged. So if you say you spoke to Mrs. Myers, revenue agent number 12345 on Friday at 4 p.m., they're recording that call. They can pull it and they can see what you're saying. You have the right to pay no more than the correct amount of tax. You only have to pay what's legally due. That does sometimes include interest and penalties. And if you've overpaid or you were incorrectly taxed, the IRS has to give you your money back. An example of this, if your time space percentage was not calculated correctly and that caused you to pay more taxes, this right ensures you can file an amended return to claim the correct deduction and get a refund if you're due a refund, or if you owe money, it would reduce how much you owe. The fourth right, to challenge the IRS and be heard. You can challenge the IRS's decision by providing additional documentation and raising your objections. The IRS must consider your evidence and provide a response if they disagree. I just worked with a client. We were going back and forth with the IRS for 3 months. But guess what? He won because the IRS was wrong and he has rights. So we just exercised his rights. An example of this would be if the IRS denied some of your deductions. You can submit receipts or mileage logs if it's for your vehicle, or even logs of your schedule, your daily activity, whatever it is, you can provide proof so that you can challenge their position. Right number 5, the right to appeal an IRS decision in an independent forum. If you disagree with a decision made by the IRS, you can appeal to the IRS's Independent Office of Appeals, or if needed, you can go to tax court. And this ensures you'll have a neutral review, unbiased, of your case. So, an example here would be if the IRS makes a change to your return and is not correct, you can file a formal appeal to have your case reviewed by someone that wasn't a part of the original decision. Right number 6, the right to finality. This right ensures you know the time frame for resolving your tax matters. They cannot come after you for dear life for the rest of your life. They cannot hold anything open over your case forever. In some cases, there are even statute of limitations where once it's past that point, even if you would have owed the money, in some cases, they can't touch you because you have a right to finality. You should be informed about any decisions. If you get a letter from the IRS, make sure you are open in this letter, reading it and responding, because when we don't respond, we're telling the IRS, okay, whatever you say, I agree. Do whatever you want to do. That's how they perceive our lack of response. You can always ask for more time if the IRS asks you to do something or provide something by a certain day. An example here is if the IRS audits you, they generally have 3 years from the date that you filed your return to audit you. And this right protects you from them auditing you forever. Now, if there is fraud, they don't have a statute of limitations. They can come after you as long as they need to. You have a right to privacy. You'll remember in the last presidential election, Donald Trump did not want to give over his tax returns, and the IRS couldn't turn them over because we have a right to privacy. Your interactions with the IRS must respect your privacy. The IRS can only ask you about things that are legally required, and they can only be minimally intrusive into your life. So if you're audited by the IRS, they can't ask you personal details like how you spend your money outside of your business. But if you open that door by mixing business and personal together, I've seen them have a lot to say when we went for payment plans for our clients. One of the saddest ones that I saw was a lady who's got into some tax trouble. She told the IRS she couldn't afford the payment plan they calculated for her. And when they were looking in her business account, and she just so happened to be a corporation, and she shouldn't have been, but she was. And the IRS auditor saw that she had given a lot of money to her church. The IRS auditor had the audacity to say to her, you would be able to afford to pay your taxes if you weren't spending so much money giving it to your church. Now, they had no right to say that about her religion, of course. She opened that door because they got to see it. So they would have never been able to get into her business had she not put it out there. So it's just like lawyer shows on TV When you see the lawyers tell the person when you take the stand, just answer the question that you're being asked, you want to kind of treat the IRS the same way. Number 8, the right to confidentiality. The IRS must keep your information confidential and they cannot share it without your consent, except authorized by law. Your tax professional cannot share your information unless they are subpoenaed or they have your permission in writing. We will not share your information. I have had people's spouses call me asking, can you send me my wife's tax return? We're going to go buy a house and I need it. Sorry, I can't. You guys file separately and I don't have permission to share this with you. Number 9, the right to retain representation. And we'll talk about the different people that can represent you with the IRS in a few minutes. But you can hire a tax professional like a CPA, an enrolled agent, or an attorney to represent you in dealing with the IRS. If you can't afford representation, you may qualify for assistance through the low income taxpayer clinic if your income is low enough. So, an example is if the IRS sends you a notice, you don't have to handle it alone. You can designate a CPA like myself or an enrolled agent or an attorney to respond on your behalf. If your tax professional is not a certified public accountant or they're not an enrolled agent and they did not do that tax return, they cannot represent you because they don't, their license, their practice rights before the IRS doesn't allow them to. And number 10, you have the right to a fair and just tax system. The tax system should consider your circumstances. They do consider financial hardship and will allow you to request relief if you cannot meet your tax obligations. Now, you all may have heard commercials on the radio about a Fresh Start initiative, and they'll tell you claims about I paid them to help me and I owed a gazillion dollars and now I don't owe any. There is no such thing as a fresh tax initiative. And offers in compromise are not very common. To qualify, you basically have to prove that you're insolvent, aka that you're broke. So, usually, the best case most people can get is an affordable payment plan. I'm not saying no one qualifies for these things. I'm just saying I see a lot of people spend a lot of money because they've heard things that aren't true. I'm not sure why the FTC hasn't shut these things down yet, but at least once a week, I talk to someone who was involved in one of these situations. So an example of a fair tax system is if paying your tax bill would create a financial hardship, you can't get life-sustaining medical treatment, or you would lose your home, then you can request a payment plan, or possibly you might qualify for an offer in compromise in this right. And understand that when you do get these concessions by the IRS, they ask you for a lot of information so that they can make sure that they are sure that you really qualify. Um, have you all, has anyone here heard about the Taxpayer Advocate Service? Has anyone heard? And y'all can nod your heads if you hear me. And no one, I don't see anyone that's heard of it. Okay, I gotta tell you about the Taxpayer Advocate Service because a lot of people does not know that this service exists and it's free. Um, so the Taxpayer Advocate Service is an independent organization within the IRS, and their job is to be your voice within the IRS. This service was established by Congress, and their mission is to protect taxpayer rights and help individuals and businesses resolve tax problems where they haven't been able to resolve them through normal IRS channels. The TAS, that's their abbreviation, was designed to help taxpayers who are having significant challenges. Their service is free, it's confidential, and They help you when normal IRS processes just seem to fail you. They are to be considered as your advocate within the system to make sure you're treated fairly and your concerns are addressed. Now, in my experience with them, I have called the taxpayer advocate or had my clients call them in cases where their refunds were held up. And I've seen people face an eviction and the IRS was doing whatever they were doing and holding up a refund and saying it wasn't available. So I sent them to the taxpayer advocate service. Of course, we had to provide documentation, but we were able to get refunds released. Now, in the taxpayer advocate service, a lot of times the timeline will start over. So if you're working on something and then they get involved, the first thing they do, like any person is good at representation, they will ask for more time so that they could review, go over the situation. So calling them can help you, but just be advised that it can also prolong things a little bit sometimes too. So there's about 2,000 people. Well, there were. I don't know if that's changed in the last couple of weeks, but there were 2,000 people in this department, and 1,400 of them were advocates. And these advocates personally assist taxpayers with resolving their problems. You might qualify to work with the taxpayer advocacy service if you are experiencing financial hardship due to your tax issue, if you faced a delay of more than 30 days in resolving your problem, or if you haven't received a response from the IRS within the amount of time they promised you. And in most of their communications, they will tell you when you should expect to hear from them. So, beyond individual cases, the TAS also works to identify and address systemic problems within the IRS that affects taxpayers. So, the National Taxpayer Advocate, they submit annual reports to Congress, telling Congress and recommending to the legislative bodies about changes to the law that need to happen to improve the tax system. So, when should you contact the TAS? If you're experiencing harm, economic, financial harm, or significant costs, if you can't afford professional representation fees and you can't afford it because of a tax issue, if you are facing immediate adverse threat of action from the IRS, and if you try to solve your problem through normal channels and you haven't been successful. So this isn't your first step. You want to try to resolve everything the regular way. And if you're not getting the help that you need, then you call them. So, how to contact them? This is their website. And if you don't remember it or write it down, you can remember 911. We all know what 911 is, emergency, right? The IRS has a form 911 that you can file. But the easiest way is to go to the taxpayeradvocate.irs.gov website or call the 1-800 number. And if you forget it, you could think about this years down the line. If you just Google IRS taxpayer advocates, if you just Google it, it's going to come up. So part of advocating for ourselves is also knowing how to find information. And whenever you're looking at IRS websites, make sure it says .gov on the end. It's a lot of scammers and bad actors out there. So make sure it says .gov, okay? So here's a real life example of how they helped another one of my clients. So a child care provider submitted her tax return. She claimed her time space percentage for her business use of home. The IRS flagged her return and they held on to her refund because they said her calculation was invalid. She gave them the additional documentation, the hours that she worked, but the issue just dragged on for months. It created a financial strain for her because she was dependent on that refund so that she could make repairs to her house so that she could comply with licensing. And then this would give her the ability to get licensed for more children and make more money. We contacted the taxpayer advocates, explained the situation, gave them everything we had submitted, and within 2 weeks, the taxpayer advocates were able to get her refund. She was able to get her repairs. She was able to go from being licensed, I think she was at like 7 kids. She was able to go up to 14 kids or 16 kids, and life was good because we contacted the taxpayer advocate service. So again, it is free. Yes, you can hire a professional to help you, but if you can't afford to, this is an option for you. So let's talk about some of the professionals that you might decide to hire. While the IRS does have that resource for you, the taxpayer advocates are not the only ones that you can call for support. You have the right to work with your own professional. I've worked with clients that have had really great experiences. I have called the taxpayer advocates with and for some of my clients. The important thing for you to know is that you are your own biggest advocate first. And you have to, in order to be successful, you have to know all of the options that are available to you. And free is not always best. Something else I want to mention about TAS is that the process, again, it gets started over when you start working with them. So remember, this person has to get your information, they have to get brought up to speed. And if you're facing a deadline, they're going to ask for an extension because you don't want to miss IRS deadlines. And when you work with this group, you are assigned someone who will help you. So you don't get to interview this person, you get to work with whomever you're given. And you do have the right to hire a professional of your choice. And in the next section, I'm going to tell you about the different types of tax professionals you can hire, what to look out for when selecting one. We'll talk about some red flags to avoid, and even how to report unethical behavior if you encounter some. So these are the types of professionals you can hire. I am biased. I think CPAs are the best because I am one, but all of these people can help you. You have certified public accountants, you have enrolled agents, you have tax preparers, and you have tax attorneys. Now, tax attorneys are usually called in, we call them in when it's criminal charges on the line. When someone has done something criminal like tax evasion or tax fraud and they're facing criminal charges, that's where you have no choice but to get a tax attorney. If you running the risk of going to jail, you need to call an attorney. So let's talk about certified public accountants, CPAs. What do we do? CPAs are licensed professionals who have passed the uniform CPA examination. We've met our state's education, experience, and ethical requirements. Most or a lot of CPAs provide a wide range of services, including tax preparation, financial planning, audit representation, tax strategy. And one of my favorites are wealth building and helping people to increase their profitability. To become a CPA, you are required to have at least a bachelor's degree, but a total of 150 college credits. So most of us do have master's degrees. You must pass a 4-part exam to become a CPA, covering auditing, financial reporting, regulation, which includes tax, and business concepts. CPAs are licensed by state boards of accountancy, but due to laws of reciprocity, many CPAs like myself do work across all 50 states. CPAs are required to complete 40 hours of continuing education every year or as required by state. If you have multiple licenses, I personally do about 60 or 70 hours per year. And this ensures that we stay updated on tax law changes, financial reporting standards, and best practices. CPAs have unlimited representation rights before the IRS. That means we can represent you in audits, appeals, and tax court. as long as it's not criminal. When you should choose a CPA, if you need year-round financial guidance or complex tax planning. For services like structuring your business, calculating which structure is best for your tax entity, how can you make out best, and also for creating long-term tax strategy. And CPAs are also pretty good at helping you increase profitability and to grow your business. A CPA can help you with your time space percentage, even how to make sure that you are maximizing it. Let's see if this works. I did not see that. Oh, that's pretty cool. Okay. So enrolled agents. I started out studying to become an enrolled agent, and then I changed to a certified public accountant. So enrolled agents are federally licensed tax practitioners who specialize in taxation. They're authorized by the IRS. To become an EA, you just, well, not just, but you have to pass 3 exams. They're called special enrollment examinations by the IRS, but it's only about tax. And former IRS employees can become enrolled agents and they don't have to take the exam. CPAs do not, I'm sorry, EAs do not have a college requirement, but they do have to take 72 hours of education every 3 years. And they have to do a minimum of 16 a year, which includes training in ethics and learning about the latest tax laws. Enrolled agents also have unlimited representation rights before the IRS. So they can also represent you in audits, appeals, and collections. But EAs, like CPAs, cannot litigate in tax court. So when should you choose an enrolled agent? If you need tax preparation, if you have an IRS dispute to resolve, or you need help negotiating payment plans. So, for example, a EA might assist you if you have a notice about an underpayment or you need to get set up with an agreement. Now, all 3 of these professionals that I'm going to tell you about, or all 4, everybody can do the same thing. The big difference is the attorney can protect you from jail, and the taxpayer, the tax preparer, which we're going to talk about next, they can only represent you if they did that particular return. So the tax attorney, the JD, the Esquire, tax attorneys are lawyers. They just chose to specialize in law. They focus on complex tax matter, legal disputes, and litigation. They must hold a Juris Doctor JD degree from a law school. They must pass the bar exam. And some tax lawyers also have a master's in law taxation. Attorneys must meet their continuing education requirements by state, but they are not required to have so much education specifically in tax because they study the whole law. Tax attorneys have unlimited representation rights, including the right to represent clients in federal tax court. So you might choose a tax attorney if you are facing legal action, such as fraud allegations or criminal investigations. So for assistance with negotiating complex strategies or legal disputes, you might want to call in an attorney. And a tax attorney will represent you in tax court if you're disputing a large liability and mainly if you're facing penalties for tax evasion. So here is a chart that has a comparison. Oh, I didn't talk about the taxpayer. I didn't do it the tax preparer. Let's see. So I didn't do a slide for them, but it's not because I don't love them. So I will tell you about the tax professional, the tax preparer, because I started out as a tax preparer before I was licensed. So a tax preparer has no educational requirement. They do not have to graduate from high school. They do not have to take any type of special tests. They cannot represent you in tax court. This is a person, they often say, I do taxes. Now, there are some people that aren't required to do these things, but they do them because they really like I really cared about my craft and I wanted to be the best and I wanted to do good for my clients. So I'm in no way saying that the tax preparer is not qualified. I'm just saying anyone could hang up this Zoom call, buy some software, and decide that they are a tax preparer, and that would be fine. Um, there is an IRS annual filing season program, and in this program, the tax preparer does, I think it's 18 hours of training. It's voluntary. They don't have to, and they can decide that they want to take this education to help their clients. So it is illegal for me, if I'm a CPA, I cannot call myself an enrolled agent or a tax attorney. And the same thing with any of these other people. So a lot of people think that everybody that does taxes is a CPA. They're not. And the best way to know if you think your person is a CPA and you're not sure, you can look them up. It's a national database, CPA Verify. I think there's a few states that don't participate though. That might have been updated in the last couple of years. But you'll know if a person is credentialed because they'll usually tell you, they'll brag about it. They'll tell you, even a tax preparer who may not have an official license with the IRS, they'll still tell you, I take my continuing education, or whatever it is that they've done to make themselves qualified to help you. So the key takeaways is not uncommon, um, is not very common rather, for people to end up in tax court. But in the event that you like to take the IRS to court, you do have that right. And you'll notice that while certified public accountants and enrolled agents and attorneys are licensed professionals with unlimited rights to represent you, only the legal lawyer can litigate, take legal action, be involved in a lawsuit. So, in the context of tax professionals, it refers to the ability to represent a client in a court of law, such as the United States Tax Court. So, key points about litigation in tax matters: only licensed attorneys, and there is another designation, some non-attorney tax preparers that pass a U.S. court examination. Litigation occurs when a taxpayer disputes a final IRS decision, such as a notice of deficiency or an audit result, and they can't resolve it through normal appeals or an administrative process. At that point, if you're working with someone that cannot litigate, they will probably have already told you we may need to call in somebody else that can litigate because they don't want to lose. The role of litigation, it involves presenting evidence, making legal arguments, and following court procedures so that you can argue your case before a judge. So suppose the IRS says you owe $50,000 in unpaid taxes because they disallow your deductions. And after multiple appeals, you still believe your deductions are legitimate. You might take your case to tax court to argue that your deductions are valid. A tax attorney or a certified court representative, I actually have a couple of friends that passed that exam, would be able to handle this process for you and file the legal documents. And most of these people, that is all they do. Once they take that test to go to tax court, most of them, that's all they do is fight the IRS. It's what brings them joy. I considered it. So let's talk about, has anybody here ever worked with a tax professional or maybe almost worked with a tax professional and they just made you feel uneasy? Like you felt like something isn't right. Like you just can't put your finger on it, but you just are unsure. Have you ever felt that way or heard somebody give some advice and you thought to yourself, this can't be legal? Okay? Or this is too good to be true. Well, here's some red flags to watch out for. Now, while most of the tax professionals are honest, trustworthy, law abiding people. There's bad actors in every bunch. And they can cause some really serious problems, like I told you about with my aunt. Here are some things that you want to look out for. Red flag number one, people that guarantee you large refunds without any documentation. It doesn't matter how good this tax person is, they cannot promise you a large refund without reviewing your records. If a taxpayer tells you you'll get a large refund before seeing your receipts or your deductions, that's a major warning sign. Now, if you come and you say to me, Shanita, I have 7 kids and I made $20,000 profit this year and I paid $15,000 in tax, I can say, oh, yeah, girl, you're going to get a refund because I have some context behind that. But if my advertisement just says, come to me, you'll get a large refund, I'm not acting in integrity because there's no way for me to promise you that. Another red flag to look out for, refusing to sign your tax return or providing their P10. So all paid tax professionals, licensed or not, we have what's called a paid tax preparer identification number. We have to put that P number on our returns that we do, and we have to sign them. Now, it doesn't have to be a handwritten signature. That P10 can act as the signature. So if someone is doing your return and you are paying them, their name should be there. If they refuse to sign it, it could be because they're not authorized to do so or because they're trying to avoid accountability. Now, whether they sign it or not, if it's your return and it's filed, it's on you. If a person you paid to do your return and it says self prepared at the bottom, that person is denying having ever had any tax interaction with you. It is also highly illegal for someone to charge you based on your refund size. We are not allowed to charge you one price because you're getting a big refund and another price because you're not. Ethical professionals charge flat fees or hourly rates and is not a percentage of your refund. So, an example of something to watch out for is someone telling you you're going to pay 20% of your refund. This person would be inclined to inflate deductions so that they could get more money, that 20% would grow. And this also exposes you to IRS scrutiny. I'm going to go even further and talk about some of the other things that I've seen unethical tax preparers do. We've been hired to represent taxpayers before the IRS. They got into trouble for things they didn't even know were on their tax returns. There are about 600 people here today. I don't want anyone to hang up this call and ever allow anyone to file a tax return on your behalf again without feeling comfortable with it, having an opportunity to review it and sign it. You need to understand where all of the numbers on that return came from. If someone is making up numbers for you, this is a big problem. When you go to have your taxes done, their job is to report what happened exactly as it happened. A good preparer will not accept responses from clients as, can we use the same numbers as last year? Or just put me down for the max. But because this behavior has been going on for so long, taxpayers aren't aware that this is bad. Other things I've seen taxpayers do is I actually was on a call with a new client and we had to call her old tax person to get a copy of her return so that we could do her new year. And before she had a chance to tell him he was on three-way, he was asking her how much you want to get back for your taxes this year. I don't get to decide that. The tax person, the taxpayer doesn't get to decide that at filing. Through tax planning, we can decide how much you owe. But if your tax person says things like that, then that is a red flag you want to look into. Be cautious. The tax forms and numbers dictate what's going to happen on that return. Legal strategies. So, If you've experienced unethical behavior from a tax preparer, you can report an unethical tax preparer. The form number for that is, I don't know why it's so many numbers, but it's 14157. And you can fax it in or mail it in and include any evidence you have. So this person may have given you a flyer and said, I guarantee you'll get back X amount of money or something like that. And then the next thing you know, you're being audited and you didn't even know you did something wrong because this person represented themselves as a professional, but they did something unethical. So, if you have to report a person, this is how you would be able to report a person. So, now I want to talk a little bit about, oh, my slides are going where they want to go. Just a second. So now I want to talk about actually putting your advocacy for yourself in action and making sure you understand how to advocate for yourself. So, some situations where you might have to do this is if you're a single parent and you pay for more than half of the cost for maintaining a home for your child, but the tax person said, no, you're single. We're not doing head of household. What you want to say to the tax person is, I believe I qualify as head of household because I meet the requirements. I have records to support this. Can you explain why you think single is more appropriate? So when you're talking to people, use clear fact-based communication. Ask for an explanation if you disagree with their suggestion. Sometimes people make mistakes and they will thank you for bringing it to their attention. Another situation, let's say the IRS denies your home office use or your business use of home use. And they'll call it a home office, even though you don't just have an office, you have a whole childcare program. And they may say your records don't meet their standards. You can say to this person, Mr. IRS, Miss IRS, I like to clarify why my deduction won't be, I like to clarify why my deduction should be allowed. I have my records showing my time space, my receipts for improvement, or whatever you have. Could you review these documents and let me know if additional documentation is needed? So you are allowed to stand firm. You are allowed to ask questions. The important thing when dealing with these people, a lot of them, I'm trying to be nice. A lot of them can give you the impression that they aren't wrong and that they cannot be wrong, but we know they're human, so that's not true. But the important thing is to stay calm and be professional, even if you disagree with their decision. And whatever evidence that you have for yourself, make sure you present it with um you're speaking clearly and you're giving them evidence in an organized manner. For example, don't give them one document and say, I'll give you the rest later. Come to them and have all your ducks in a row, and they will take you seriously and be able to evaluate it. So remember that advocating for yourself is about staying informed, being organized, and being confident in presenting your case. And when you practice these scenarios, it will help you to prepare for some real life tax challenges. Now, I promise y'all that I was going to save lots of time for questions and answers because we did have some questions and answers from, well, some questions from some prior webinars. So we have plenty of time. So if you haven't had a chance to drop your questions in the chat box, I invite you to do that now. Also, I want to give you all access to a masterclass. It is free. It is my child care tax savings masterclass. It is one of my favorites. It's actually it comes with my book. When people buy my book, they get this free, but I'm giving you this master class and I go over 10 of the most commonly missed tax deductions that childcare owners miss. So if you opt into it, you can watch it at your leisure. It is pre-recorded. Um, and at the end, you also get a book and it has like all of these advanced tax things. So I put the link in the comments and a QR code, and I am going to start answering your questions. Let us see, what do we have? So, question number 1. My question is, can you claim items that you purchase on yard sales? Yes, you can. You absolutely can. Anything that you buy for your business that is ordinary and necessary, you absolutely can claim. And how you would claim them is in your bookkeeping records. You want to make sure you're recording this transaction because remember, it's not going to be included in your bank statement. So it might not show up on your profit and loss unless you get it there. If you're working with a bookkeeper, what we have our clients do, because we do bookkeeping for some of them, is we tell our clients to go ahead and they have access to a portal. We'll tell them to upload a receipt if you paid cash for something so that we'll know that you had this receipt. Does this class count towards the workforce registry? You will receive an attendance certificate that you were here. And I believe that is what you were answering for workforce registry. So the answer to that would be yes. CCPU team, someone wants to know where's the link for parts 1 and 2. They weren't able to, they would like to rewatch them. So I believe that all of the parts will be resent again as long as all of the resources after the training is over and you'll have access to go back and watch them. And I believe they gave out the slides as well. So what price should a tax preparer specializing in childcare charge? I know each person has their own rates, but on average, I've heard of 300 to 550. Is it correct they charge that? So, thank you for acknowledging I can't speak to anyone else's prices, but I will tell you that a schedule, and you got different types of returns. So at our firm, a Schedule C tax return, because of our specialty, that starts at 750, and entity returns start at 1,000. So if someone's doing your return for 300, you got a steal of a deal. I would just make sure that they specialize in what you're doing, but I don't think any of those price, I think we couldn't operate charging those prices. Um, and it's because remember when most people come to get their taxes done, you have to pull the information out of them. Or if you do a return based on what a person gives you, you know you're not getting the best result for that client. And to that's not fair to not give them the best service because you have to do so many returns to make so much money. And that's really when we used to do individual returns, that's how fast it was, but it was easy. But when you're dealing with business owners, you don't just have the individual component, you also have the business component along with that. And you want to make sure they're maximizing their deductions. So the next question. My son owns the house that I run the daycare in. Just wondering if he will be able to deduct the space using his taxes. Sorry, son. The person that owns the space and owns the building gets to deduct the space. If your son owns the home, but he's not actually running the business and he has no income, he can't deduct expenses. Now, in your case, your situation, it all depends. I don't know what agreement you would have with your son, if he's charging you, if you're paying anything, but very generally speaking, without knowing all of the details, it doesn't sound like your son can get the deduction because he's not the business owner, he's just the homeowner. And whatever the childcare owner, mom, is spending, mom would be able to get deductions. Oh, I'm sorry, the question is continued. She also said, would he be able to deduct using 8829 and I don't pay any rent for him? Can we get a copy of the checklist shared in session 1? Yes, ma'am. You will get the copy of the checklist. And unfortunately for your son, no, he cannot use 8829 because he doesn't have a business. You do. And think about it this way, Mom. If you think about it this way, you aren't paying the expenses, so you're able to make more profit. So because you're able to make more profit, you're still coming out with more money after all. If you were to also take deductions, you would be double dipping. Now, you might not pay rent, but he may have you pay utilities for use of the space. Not sure. How can you reach us to prepare your taxes? Thank you for asking. Our website is thechildcarecpa.com. And also, if you sign up for any of our mailing lists like this training, you'll see our information there as well. Next question. I am the owner of a child care center and a family child care home. My daughter runs and is licensed for the family home. I'm the site director for the center. We do have 2 EIN numbers. How do I file the business taxes? Good question. I'm glad you asked that question. See, this is why I love California so much. So, okay, an EIN number represents a business in IRS world. So if it's one EIN number, is one business. 2 EIN numbers, you have 2 businesses. So the daycare, whoever's name the EIN is in, that's who owns that particular business. So if you own both the center and the family childcare, then those are both your businesses. And I'm going to assume that these are both sole proprietorships. So if so, you would have 2 Schedule Cs. And I'm saying Schedule C like cat. Y'all know we went deep into Schedule C last week. So you would need to file those returns. If they were formed as corporations, you would file 2 corporations. So it really all depends on what that EIN letter says and how your tax structure is. Um, I have another question. Look like somebody didn't finish typing it, but I am going to address it because I'm going down a list. It says, I was married, but I separated 8 years ago. So if you were married and you're still legally married and you don't have any minor qualifying children, you would be married filing separately. And when you're married filing separately, you have to include your spouse's date of birth and social security number on that return. Now, that does not give your spouse access to your return, to your refund, and it does not make your spouse responsible for any taxes that you might owe. But the IRS just needs to know if you're filing separately, who you're filing separately from. Now, I hope I answered that question that I think you had. How do we find a tax preparer that deals with daycare taxes? That would be us. Um, if you choose to look for somebody else, you could probably Google and you might find somebody. Um, if I am a widow and it's been almost 3 years coming now in July, I'm sorry for your loss. Then I have to be filing by myself. Yes, it would seem as such. You get 2 years. So the year they pass away, you can be married filing jointly. And then the next 2 years, well, we have to go by the date that they passed away. Then you get to be qualifying widower. If you have a qualifying child. If you don't, then yeah, you would now be single. Hello, what is preferable? Having a surplus of income after business expenses in the business account or to transfer that to your personal account? It depends. So I'm big on telling my clients that you do not want to bankrupt your business. You want to make sure you have enough money in your business for your business to sustain itself. You don't want to find yourself, and it depends on your business's goals too, right? That's one of the first things we ask when people hire us to be their accountant. When we work with them for tax, sometimes it comes up, but when we're their ongoing accountant, one of the first things we want to know is, what is your business goal? So if your goal, oh, my screen just moved. How did that happen? If your goal is to grow your business and run a sustainable business, then you wouldn't want to bankrupt it. But I'm not a fan of leaving too much money in the business. So maybe leaving enough in the business, and it all depends. It really depends on your financial situation, your cash flow situation, but it's your money. And if you're a sole proprietor or a partnership or an S corporation, you're going to be taxed on that money whether or not you put it in your personal account. So it actually, that's any business. You'll be taxed whether or not you take the money. So you may as well take as much of it as you need. What if you have no dependents and you are not married? If you have no dependents and you are not married, you would be able to file as single. I was going to make a really mean joke about my husband and kids, but my husband might be watching. um, can you file as head of household and still get child credit for a disabled child? So you can only get the child tax credit for kids up until they turn 17. So even though that young adult is disabled, we still can't get a child tax credit for that their son or daughter of ours. About the child tax credit, the year that kid turns 17, even if they turn 17 on December 31st and they were 16 all year long, you lose the credit in that year. As for the 21-year-old, you can still be head of household and claim them, but you cannot get the child tax credit. Another question. Hi. In 2023, I bought an expensive vehicle for business and personal use. I was able to pay for it that year. I filed my return and declared 70% for business and 30% for personal. That benefited me a lot when I did my taxes. But in 2024, when the school year started, I enrolled more children and had no seats available to pick the children up from school. I had to buy in 2024 a bigger used vehicle, which I'm still paying for, and it is only transporting the children. And I left the other one for personal use. How will this work on my 2024 return? I will bring this attention to the IRS. So, my answer for you, thank you for having such a clearly typed up question. I hear people explain it and they don't explain it that clearly. My response to you is it depends. First of all, I do not support my people in taking a vehicle that is part business and part personal and ever doing depreciation on it. I mean, I discuss it with them, but by the time I get done talking with them, they see things my way. And the reason why is because there's something called depreciation recapture. So if your person, and I don't know what they did with your return, if your person depreciated and they actually wrote off the full 70% that you purchased for the vehicle, the IRS will recapture some of that deduction this year and it gets treated as ordinary income. If they just did mileage and they just did 70% of the miles, then you'll be fine. Nothing's gonna happen. But if they did depreciation, you may have some depreciation recapture. And then we also don't know if they did accelerated depreciation or if they just did regular depreciation. So the answer for you is it is going to depend. You may have to pay some of the benefit back, but you're not going to get in trouble. You didn't do anything wrong. You didn't know your situation was going to change this year. And congratulations on growing your business. I bought a bigger car at the beginning of this year because I felt God saying I was getting a grandchild. I thought I was getting a grandbaby child, but I ended up getting a bonus grandchild, a 13-year-old. So now he wants to drive the car. But it wasn't a big thing to me because I only take mileage for my vehicles. I don't write them off because I never know if I'm going to drive more or less. I'll be speaking at a conference in Ohio in March. I live in Delaware. I'm going to drive mainly because I want to drive the car far. But as long as it's not snowing, I'll drive. I'll pick up a lot of miles that way. So That's a factor. And we talked a little bit about this last week. When you're deciding how you're writing things off, you don't have a crystal ball, but you also want to consider the future if possible. Do you have the capacity to grow? And whenever someone comes to us and say, I want to write my whole vehicle off, I say, now let's talk about this. And we'll also look at how much would you owe or your refund be if you don't. And then, we'll let them make and we talk about that um in this master class. We actually talk about strategically using depreciation. I have a question. This is the next question. What are the miscellaneous and what goes there? Your guess is as good as mine. I do not like miscellaneous. I talked about that last week. The reason I don't like miscellaneous is because the IRS believes in their infinite wisdom that they have given us enough space to write off, enough categories to write off everything that we need to write off. So if they've given us everything we need to write off, there should be no reason in their mind for us to have a miscellaneous anything. Last week I did list some things that I've seen people put there, but I don't allow the tax preparers that work for us to use that line. It's got to be something really rare, and I can't think of anywhere else to put it. One thing that we might put there is school trips. Like if you take the kids on field trips, I might allow that to go there. Um, Sometimes, yeah, that's one of the only things. But I did list some things that I see there, but I don't like to use that. Here go a really good question. This is a cute question. Can a pregnant woman file as head of household? We so should be able to, but unfortunately, the answer is no. We cannot file as head of household. Wishing you a safe pregnancy, safe, happy pregnancy, and a healthy baby. But sorry, we cannot file as head of household. Another good question. Are tax brackets determined by gross income or profit? Tax brackets are determined by taxable income. So in your business, your taxable income is based on your profit. Think about how unfair it would be for the government to charge you on all of your money that you earn, not taking into consideration of all the expenses you had to pay. So it's always going to be based off of your net profit. Is there any way to know how much my husband would have gotten back from his W-2 if he didn't file for me? Absolutely. Yes, there is. He can have the text. Some softwares will split it where the text person can just say, let me know. And then sometimes, depending on what else is in your situation, the text person might actually have to do another return with just your husband. But yes, there's definitely a way. Um, I always tell people when they ask that question, brace yourself. Next question. Can I declare losses when the parents leave without paying? And that was all caps. She felt that in her spirit. And I'm sorry, I'm going to have to tell you no. And we talked about this last week. And the reason why the answer is no, well, first of all, I'm making an assumption. I'm making an assumption you're a cash-based taxpayer and that you pay taxes on money you receive and not when you earn it. That's most Americans. And the reason the answer is no is because you never reported the money as income because you didn't receive it. So to deduct it would be to not count that same money twice because it was already not counted when you didn't get it. And then for you to deduct it, it would be not counted again. So you do still get to write off all of the expenses that you paid in caring for those children. So a piece of unsolicited advice here is to, and I teach this in another one of my workshops, childcare profit systems, to try to get set up with automated payment systems so that you can get your payments and get them collected up front. But no, sorry, we can't deduct that. Is lawsuit money taxable? What can I do to avoid paying taxes on it? I heard if invested in property within a certain time, I can avoid taxes. Some lawsuit money is taxable, some is not. If the lawsuit money is to make you whole, generally speaking, it is not taxable. Um, there are some lawsuits that some really big ones that are going on right now for discrimination with some farmers. Those, even though even though those ordinarily would be taxable, they're not because of a federal thing that's going on. So it really depends. And whether or not you invested in property doesn't have anything to do with lawsuit funds and their taxability. So I would suggest talking to your tax person and also talking to the attorney to find out to make sure you understand what that settlement is for. Now you might understand what happened in the case, but understand what they're paying you for. Is it for pain and suffering? Is it for lost wages? Lost wages is usually going to be taxable, but pain and suffering usually isn't. So it all depends. Will you send an email with today's presentation? I need to leave because I was in the hospital and I don't feel well. I'm so sorry, and I hope you feel better soon. Yes, the presentation will be sent out. Um, I would like to know which business structure is best for a childcare when filing taxes. We are two providers, my wife and I. That is something that I cannot say without knowing more information. Um, of course, all of us tax people have our favorites, but the one that's best is going to be the one that gives you the best tax structure. So to get that answer, you actually need to have something done. We call it an entity analysis, where we look at your situation, ask you a bunch of questions, and then based off of that, we're able to make, tell you if you do this, this will be your tax liability. If you do that, I do talk about and entity structures and how they work. I talk about that in this training as well. Next question. Can they charge by the number of forms? Yes. Tax professionals, we can charge by the number of forms. We can charge by the complexity of the form. We can even charge, and we try not to do this, but sometimes we have to. We can actually charge if a person keeps coming back and asking us to make changes. So that's why we try to equip our people. We don't want to keep charging people. We want to do it right one time, the first time, so we can do other things. But the only thing that's really illegal to charge by is how much your refund is. Another question. This is a good one. I hear this one a lot. I hear that paying parents in California only can claim up to $3,000 for the year. Does that mean we as providers only have to report up to 3,000? No, we have to report all of our income. We talked about that in webinars 1 and 2. We have to report all of our income, even if no one is watching, even if no one is reporting. Because what it is the parents can only get credit possibly for up to 3,000, but they still report the full amount. So a calculation happens to determine how much of a credit they'll get. So you have to report all of your income. Next one. I'm starting a daycare with my sister. We are both on leave. When we have to do taxes, what form do we have to fill out to prove the income we receive? So if you and your sister, and I talk about all of the structures in this class too. If you and your sister, excuse me, are starting a business together, you are probably gonna file, you are probably gonna file as a partnership. And I say probably because I don't have all the information, so I don't want to say in fact a thing and then you have something going on I'm not aware of. Can we go over the tax bracket again? Maybe if there is enough time, because we got a lot of questions, but I can show you where to find them. If you go to Google and you go to 2024 tax brackets, you can see all of the tax brackets here. So I don't think we'll have time to go back through them again, but these are the tax brackets. Can you claim your 21-year-old disabled child who lives with you and I'm head of household? We can only get child tax credit for children that are 17 and under, but we absolutely can claim the child and we absolutely can be head of household, but we cannot get child tax credit for a person that's over 18, over 17, 17 or over. So I guess I should say a person over 16. Can I help do taxes and accounting for Spanish speakers too? So we do have a member of our team that speaks Spanish. However, she is out on leave and I speak very bad Spanish. I do have a lot of friends that are Spanish speaking tax professionals. So, but they don't specialize in childcare. Some of them were gracious enough to translate for us in my employee's absence. So, if you do schedule a call, we probably would reschedule your call and then get back to you when we know we have somebody that speaks good Spanish because it's important to us that we know that you understand what we're saying to you and we're communicating effectively. So we wouldn't want to tell anybody the wrong thing. How can I buy Shanita's book? You are so sweet. Thank you for asking. The book just came, well, we just launched the website on Saturday. But the website is childcareprofitmultiplier.com /childcare CPA. And I'll share it with you. Um, I'll share the book link with you. Is it better to be an LLC or private? Um, so it depends. My position, I am very much in favor of the LLC, but in California, it gets tricky because in California, you have a franchise tax that some other states don't have. And that franchise tax is $800 per year. $800 per year may not be a lot to you, but to some people, that $800 is a lot of money. So, for legal reasons, legal protections, I like LLCs. I also like LLCs for businesses that plan on growing because when you know that you're going to grow and you know that you're going to want to take advantage of some other tax strategies, you need to be an LLC. And we talk about the S corporation a lot. You need to be an LLC before you can even get that. So if you don't already have that LLC in place, you could have a year where you are just stuck paying a lot of money in taxes. But again, um, you want to make sure that you're doing the right thing for you, and you have to weigh the pros and cons. Is what I'm going to pay to become an S corp and file as an S corporation, is my benefit going to be greater than my cost? So we will tell people if they come to us and they ask us for that, if it's going to cost more money for me to do their taxes, for them to pay a payroll service, I will tell them, hey, you could want to do this, but I don't think this is best for you. Even though it's not self serving and that's money I won't be getting, I'll tell you the truth. Some people, um, some people it's just not the right time for them. Um, the next question. Can I claim the space in a rented house? Absolutely. You better claim the space in that rented house because you can get a percentage of your rent. Please, if you haven't seen webinar 2, watch webinar 2 because we talked about that. You absolutely get to claim your space even if you don't own the home in a rented house. You actually get sometimes more of a deduction in a rented house because you don't get to write off your mortgage payments. You just get a portion of depreciation. But if you're paying rent, you get to write off a portion of that rent. Can we deduct the yard since this is the juice area for the children. I'm sorry, no yard. um, I did some remodeling in my home in 2022. My tax person said I couldn't use all the deductions until I sell my home. What are your thoughts? So last week, when we talked about expenses, we did talk about home remodeling. So if you do remodeling to your home, what this does is it adds to the value or the basis of your home. And once it adds to the value or the basis of your home, it's going to add to the amount of money that you get to depreciate. So, what that person could have been saying is when you sell your house, you're going to be able to sell for more, but it should be added. And you can look at your 8829. We talked about it last week. You'll see a spot on there where it actually has a place for improvements that you made to your house. Do these deductions apply to non-licensed providers? Yes, because non-licensed providers are not running criminal businesses. Non-licensed providers are not licensed because they are exempt for some reason. So you are allowed to take your deductions. Next one. I'm sponsoring someone for a green card. It wasn't for sponsoring her. I usually add my income and all expenses. However, if I do that for 2024, there won't be any income left at all. I cannot tell you to not file an accurate tax return to help with sponsorship because that would be breaking the law, right? But I can tell you to make sure that you are not being overly aggressive on your deductions. So sometimes people are super aggressive. Like, for example, they bought a car and they wrote the whole car off this year. You'll decide to depreciate it over a number of years. Um, so aside from that, the income kind of is what it is. So I can't tell you to do less just so that your income can be higher. I hope that helps. I was told teachers can write off the expenses for a class pet. Can I write off my cat's expenses for a daycare pet? I say yes. Some of my colleagues disagree. But the cat does live with you when you aren't running the daycare. So I probably wouldn't write off 100% of the expenses. But if you have lesson plans and the cat is a part of the program, then yes. And a lot of my child cares that are in centers, they have full blown expenses for their vets, their pets. And I said vets because I was thinking about the vet bills. Um, I answered this question already about the losses when the parents leave without paying. I'm sorry that happened to you, but no, it's not a loss. Again, um, you didn't claim the money that they didn't pay you, so you can't turn around and deduct money that you never reported. This question, I provide care as friends for my family and grandkids. That is wonderful. I'm not sure what the question is there. If you want to follow up with the question, I'd be more than happy to answer it. Would I pay less taxes if I become a corporation? Maybe. And I say maybe because the corporation's tax rate is 21%. Your individual tax rate could be less than that, but I don't know. I do talk about that in this master class though. You would need to have an analysis performed. Can we claim our monthly mortgage and our business taxes? No, because we get to write off a portion of the depreciation of our home. We get to write off a portion of our property taxes, a portion of our mortgage interest, but we cannot write off our monthly mortgage payment. Here's another question. Is the EIN number only used for tax purposes or can it be used for anything else? Um, I've had my EIN requested when applying for credit cards at a bank. I've had it requested when I apply for lines of credit. I've had it asked for when I applied for different grant programs. So, but I couldn't use it, um but things like that. But I can't think of any other reason you would be able, excuse me, to use your EIN. Do you count checks from an agency for reimbursement as income? I'm not sure what the checks are provided for, but if you're talking about like a food program reimbursement, yes. But I also count the money I spend on food as a deduction. So hopefully that answers that question. If I am head of household and I earn more than $125,000, how much will I have to pay? I don't know, because I don't know what your net profit is. I don't know what other deductions and credits you're entitled to. I don't know if you have losses that carry over or other credits or deductions that carry over from your last return. I don't know how many dependents you're claiming, if there are other business income and activities. So you see how I said there's no way a tax professional could actually tell you that they can get you a refund or they can't get you a refund without actually knowing more information about your situation. Are you accepting new clients that we personally work with? Yes. We have a full service accounting firm. There's a team of us, and we do personally work with our clients. Um, Piggybacking off the fair tax rate, what if the person filing doesn't receive a refund? Is their tax repair at a lower cost? No, because I'm not allowed to charge more money because somebody is getting a refund, and I'm not allowed to charge less money because they're getting a lower refund. So that's why on our website, where it says start my taxes, we actually have the fees listed there. So that way, if somebody comes and they get a refund for the biggest refund I've ever seen so far was like $87,000. That person, for that $87,000, they paid the same amount of money as the person that got a refund for $1,000, because I legally cannot charge them more money. Um, can we write off the amount of doctor payments, medical bills that we use using our CCPU Visa card? Maybe. If you think back to our webinar 1 and webinar 2, when we talked about itemized deductions, and when we got to the part about medical deductions, I told you all that medical deductions are going to be based off of it gets limited. So you can only write off medical deductions that are like 10, that are above 10% of your adjusted gross income. Okay. Where did my list go? Should I get an EIN as a licensed exempt provider? I would, because I wouldn't want to give my social security number out to everyone. So an EIN number is the way I don't have to do that. Is it better to buy a car for your business and have a personal car so more mileage is better? So we talked a little bit about this too. You never want to let the tax tail wag the tax dog. We don't make purchases that we don't need to make or weren't going to make anyway to save money in taxes. And we don't have to, because there's a lot of strategies that we can do where we can keep all of our money in our, well, not all, but almost all, a lot more of our money in our pocket. So if you were going to get a car anyway, then go ahead and do it. But to buy a car just for mileage, that might not be the best use of your funds. If you choose depreciation 1 year, can you do mileage the next? No, you can't. And we do talk about that in webinar 2. Can we claim the registration for a business vehicle that is leased? What can go for leased vehicle or big nose? Yeah. So remember, If you're leasing the vehicle and the lease is 100% for business, then you can write off 100% of everything. But in most cases in family childcare, most cases, unless it's like a van or a minivan, it's usually used for business and personal. And when we do the business use of vehicle, the IRS does specifically ask us if um if we have another vehicle available, do we have mileage, do we have documentation? So, and the vehicle deduction is one of the ones that the IRS really likes to edit, likes to audit. Is there any filing methods for singles, no children to receive refunds? Yes, there are. I talk about a lot of them in this free masterclass, but I do want to tell you this. In a perfect world, you're not getting a tax refund. In a perfect world, you're not owing the IRS. In a perfect world, when you file that tax return at the end of the year is zero. That means you didn't. A refund usually means you overpaid the IRS all year. And that was money you could have been using for vacation, using to hire staff to help you, using for more advertising to bring more enrollment in. You could have done anything you wanted with that money. But if you wait to the end of the year to get a refund, all you just did was give the IRS a government free, an interest free loan. And then another thing I want to tell you about refunds is that remember, when you're getting a refund, some of the ways you have to do it involves you spending money. So to get this refund, you could very well end up spending more money to be able to get this refund that you might not have needed to spend. So I'm not a big refund pusher. I don't promise my clients refunds. And sometimes when they get big refunds, I'm not happy because that means we didn't make the best choices all year. And you got to think about that. If you ever, at any point during the year, find yourself wishing you had more money for one thing or another, and then you're getting a big refund at the end of the year, let's think about why. The exception to that is if you qualify for refundable credits like the earned income tax credit or the child tax credit or different things. So it's not that I love my single people with no children. I want you to get refunds if you're entitled to them, but I don't want you to do things just to get a refund that kind of cut off your nose to spite your face, if that makes sense. Um, so I think this is a follow-up clarification to somebody that did repairs on their house, new roofs, flooring, new HVAC. All of those things would be added to the value of your home and it would be part of your depreciation. And if it was done correctly, you could probably see it on 8829 and you might see it on your depreciation schedule. Speaking of which, when you go to a new tax professional and we ask for all the pages of your tax return and we're asking for that depreciation schedule, it's because we want to know, do you have anything left over that we get to write off for you this year? Um, if you own a building or if you're renting a commercial space for your daycare, then it becomes a little bit different in terms of how you write things off because it would go by your lease. If you have a 5-year lease, you would now be able to write that off over 5 years because that's how long you're going to be in that particular facility. But when we're talking about owning our home, then it gets added to the value of the home. Or if we own a building, it gets added to the value of our building. So I have two separate businesses. One is a childcare, and the other one is a clothing. And I run it on Saturdays and Sundays at the swap meet. Do I have to file separate or together because the clothing is less than 10 a year? So technically, yes, it should be separate because the we talked about the NAICS code last week. That's the code how the IRS knows what kind of business you have. And last week when we talked about this, we discovered, remember, that the IRS wants to know for this type of business what are the income and what are the expenses, right? So if you put that clothing stuff in with your daycare stuff, it's muddy in it. So if you're a Schedule C filer, you would just have a second Schedule C. So most people only charge, if you go into a professional, like an additional 100 or couple $100 for a separate Schedule C. They wouldn't charge you for two tax returns. Usually, I can't, of course, attest to anybody else's policies, but I've never seen anyone do that. And I would doubt they would. Now, if both of these businesses are like corporations or something, and yeah, you might have to pay for two separate tax returns. Can our mortgage and property tax be part of our business tax? Yes, a portion of it, as according to your time space ratio. Yep, absolutely. And we did talk about this in webinar 2 when we went through all the business use of home expenses and all that fun stuff. If you buy furniture for your daycare, what category would it go under? It's 100% for daycare. So do you still depreciate? My answer is maybe. So the IRS has something called a safe harbor, where if you buy an asset that's worth $2,500 or less, you can decide to write it all off in that year, or you might depreciate it. So I would talk with the client and I would ask them, what are your plans? Are we going to make more money next year? I would look to see, did we get a whole bunch of grants this year? Are we going to owe way more money in tax this year than we would owe any other year? Are you already getting a refund if I don't fully depreciate that? So all of those things are some things I would look at before I wrote it all off. And then I would look at how much was the equipment. And does this person typically have a lot of deductions? Because I don't want to necessarily be the hero and have you write everything off this year. And then next year, you owe a whole bunch of taxes because you have nothing else to carry forward. Um, how much can I pay myself as a sole proprietor of my business? As much as you want to. As much as the business can afford, you can pay yourself. If you give a discount or a grant for a portion of your rate, can you write off the discounted or grant amount? No. And the reason why you cannot, it goes back to the same principle of why you can't write off tuition if a family ghosts you. And the reason why you cannot write it off is because you never reported it when you received it. So in turn, you don't get to deduct it when you don't receive it. You never reported it, so it's nothing to deduct. You never counted it. I have a question. Birthday parties and celebration for children. We do put them on taxes. We call it events. Just like Christmas parties that you might have for your families. You might, what holiday is coming up? Valentine's Day is coming up. You might celebrate these events, go buy decorations, buy food. You may get your community involved. You may get the parents involved. It's ordinary and necessary for childcare to do these things. So remember, if it's ordinary and necessary, I usually can deduct it. If my qualifying child of 14 years old works part time with me, do I lose the ability to as a dependent? Nope, because that child is still a child. And also, you are still providing more than half of the support for that child. Them working with you part time is no way they can afford to provide more than half of their own support. So it's very nice that the child is working in the business and you're teaching them responsibility, but they're not an adult yet. So you still get to claim them. How can I calculate my income as a sole proprietor? All of the money that you received minus all of the expenses that go out, what's left over is going to be your taxable income. That's a very simplified answer, and it becomes easier for you to understand when you do have bookkeeping in place so you can see a profit and loss statement like I showed you in webinars 1 and 2. Next question. If my business came out as a loss for the year, is it true the IRS questions my business if this happens for a couple of years? Yes, that is true. If you have a loss for 3 years out of 5, they do not have to be consecutive, the IRS will begin to ask you if your business is really a business or if it's a hobby. Now, the reason why that matters is because with a hobby, you can only deduct losses to the extent of the income. That means if I made $25,000 in a hobby and I had expenses of 25,000, that's all I could deduct. But if I made 25,000 in a hobby and I had 50,000 in expenses, I can only deduct 25,000 because a hobby cannot give me a loss. So the IRS wants to make sure that we aren't claiming a business, saying it's a business, but it's really a hobby so that we don't have to pay tax by reducing our other income. Somebody said each year their tax guy asks them what they want to write off and they owe every year. Even if it's not us, you might want to find a new tax guy or girl because it's not about what you want to write off, it's about what you are legally entitled to write off. So he could be joking with you. Some of us accountants have dry humor. So sometimes, we joke with people and we say things that we don't really mean. Or he could be meaning and just not asking you clearly, can you give me your profit and loss statement? Can you give me your balance sheet? What do you have this year? But and I am giving you all uh a list of deductions. Like they're just common deductions sporadically put together. But I'm also giving you strategies in that master class that you can sign up for. I received a $45,000 grant in 2024. I only used 40,000 of it. What happens to the difference? Can I report the full amount? If you only use 40,000 of it and there's 5 left over, first of all, you got to remember, we talked about this last week as well. You have IRS requirements and you have grant requirements. So the donor that gave you the grant, they may have things to say about the 5,000 you didn't spend yet. The IRS, they're looking at all of your income and all of your expenses. So while you might not have spent all $45,000 from the grant, you still might have spent enough to wipe out that 40,000. You still might have more than $45,000 worth of expenses. But if I were to just pretend like your whole business only consisted of the grant and what you spent, then I would say that 5,000 would be taxable income. The donor may say you need to spend it all within a certain amount of time, or they might say you need to give it back. So I'm gonna skip and look at some of these other questions. Let's see. Is the study done? Are you going to be answering questions now? Yes, I'm answering questions. I'm not sure which study. Maybe you were talking about the training. Um, if you rent a van for field trips, yes, it's ordinary for you to rent a van to transport children in the childcare business, and it's necessary because y'all can't walk everywhere. So that's something you would get to write off. Oh, congratulations, someone. If my business buys a property, how do I categorize it in my bookkeeping? That is going to go on your balance sheet as an asset. And this is why where all assets go. Um, this is why we often tell our clients to make sure that you're giving that tax person a balance sheet and a P&L. And no, the book is not available in Spanish, but I just might put it in Spanish. Good question. That's real easy to do now with technology. Um, can I get a list of the child care CPA? I'm not sure if you mean a list of a bunch of child care CPAs. I don't have that. Um, I don't have that. I don't look for other childcare CPAs to be honest, but we trademarked the name, but there might be other CPAs out there that do specialize in childcare. I'm just not familiar with them. Um, let's see. Is there a cap on donations? Do donations need to be backed up by documentation or credit card transaction? Is it satisfactory? Yes, donations absolutely have to be backed up by documentation. There is a limitation. If you exceed it, and it depends on who you're donating to, is either 30% or 50% of your adjusted gross income. And if you donate more than that, it just gets carried over into your next year. So, um, we actually got most of the questions that we had. We had a lot of them. You all have been the best people to spend my evenings with the last couple of months. I appreciate you all. You can find us on YouTube at the Childcare CPA. You can find us on our website at thechildcarecpa.com. I hope some of you, if not all of you, register for that master class where we actually get into talking more about strategies for taxes. And thank you all so much. It's been an absolute pleasure. And I would love to do some more stuff with you all someday.
Thank you so much, Shanita.
You're
We
welcome.
appreciate all your helpful information. It's definitely been very, very helpful and beneficial for all the information you provided for this training and the previous sessions. We would like to let you guys know that you guys will get a copy of the slide deck and all the resources that Shanita mentioned. It will be sent out in an email, so don't worry. You guys will get all the resources. Also, you can view all the previous webinar recordings, including this one. It'll also be sent with the resources as well as be uploaded on our YouTube channel, which I will go ahead and link it right here so you guys can also have access to the webinar recordings. And then I also sent out our evaluation survey. So if you have not completed it yet, please do so. We appreciate and love your feedback to help us continue to offer these trainings. So before you guys leave, please take the time to complete it. And you guys will receive a certificate for attending this training. And that will usually be sent out sometime, hopefully this week or so. The resources will also be sent out sometime this week. Again, as we mentioned earlier in the beginning, we are still working on sending out the certificate for the first session of this webinar series. So if you have not received it, please do not worry. We are working on it. There's just some technical difficulties that we are working on, but we will make sure that you receive it. So again, please take the time to complete our evaluation survey before you leave. And thank you all for taking the time to attend this training. I know it's a long 3 hours, but it has really great information, and we appreciate you guys for being here with us tonight.